So if you've been keeping an eye on the market lately, you're probably feeling some serious whiplash, right? One day it's up, the next it's way down. The signals are, well, they're all over the place. And it's getting really tough to get a clear read on what's actually going on. Today, we're going to try to cut through all that noise and figure it out.
All right, so let's get right to it. The big question on everyone's mind is this. Are we actually in a bear market? I mean, it feels like one, doesn't it? There's this pessimism you can almost touch, and you can tell a lot of investors are just bracing for the next leg down. But is that feeling telling us the whole story?
And look, let's be real. This feeling isn't just coming out of thin air. The pessimism is a direct reaction to some very real and, frankly, very negative signs out there. It's a totally valid concern, and it's rooted in a weakness in the market that's just, well, it's hard to ignore.
Okay, so to really get a handle on why everyone's so bearish, you gotta follow the pain. And right now, all the red arrows are pointing to one place, the world of technology stocks. And listen, we're not talking about some small, obscure companies here. We are seeing clear, unmistakable downtrends in the absolute titans of the industry. We're talking household names like Amazon, Palantir, and even the mighty Microsoft. You know, when these pillars of the market start to wobble, everybody pays attention.
And this isn't just a case of a few bad apples, you know? This is a bigger deal. If you look at the entire software sector, using the big ETF that tracks it, that's ticker IGV, the picture is pretty rough. We're seeing some really significant, forceful declines. It's a problem across the whole sector.
So what happens when a massive sector like tech starts bleeding out like this? Well, the big money reacts. Let's follow their trail, because their moves are basically pouring gasoline on this bearish fire.
They're opening up what are called short positions like crazy. And in case you're not familiar, going short on a stock is basically making a huge bet that its price is going to go down. It's about as strong of a bearish signal as you can possibly get.
And we're not just talking a small uptick here. The number of these bearish bets against the main tech ETF, XLK, has literally skyrocketed to the highest level we've seen since 2010. Think about that. The last time people were this negative on tech was over a decade ago. That's a huge deal. The professional money is betting big against tech right now.
So here's the kicker. Because these tech companies are so gigantic, when they get sick, the whole market catches a cold. All this selling pressure on tech is what's dragging down the big indexes we all watch, like the S&P 500. And it's why we're seeing these crazy, whiplash-inducing swings every single day.
Okay, so it sounds pretty bad, right? Weakness in the most important sector, pros betting on a crash, it paints a pretty clear and pretty grim picture of a bear market. But what if that's not the whole story? What if we've been looking at this picture all wrong? This is where it gets really interesting. On the left, you got the S&P 500 you always hear about. It's cap-weighted. Think of it like a shouting contest where the biggest guys, like a Microsoft, have megaphones and their voices drown everyone else out. And that index? Yeah, it's basically just moving sideways. But then you look at the equal-weighted version on the right. Here, every single company gets the same size microphone. Everyone has an equal say. And would you look at that, it's in a clear, healthy uptrend, a totally different story. So what in the world is going on here? How can both of these things be true at the same time? Well, it suggests something way more complex is happening just beneath the surface. This isn't a market crash. It's something called the Great Rotation.
Now, the Great Rotation sounds dramatic, but it's a classic market move. It's simply when big money decides one part of the market, like tech in this case, has gotten a little too hot, a little too crowded. So they start pulling their money out and rotating that capital into a whole bunch of other broader areas of the market, maybe like more defensive stocks.
So let's walk through how this whole thing plays out step by step. First, the money starts pouring out of those big, over-concentrated tech names. That selling pressure is what creates the weakness that gives all of us that bear market feeling. But, and this is the most important part, that cash doesn't just vanish into thin air. It's moving. It's flowing into many other sectors, lifting them up. And the end result? The overall market, when you look at it through that equal-weighted lens, actually stays healthy and continues its uptrend.
Okay, so now that we have this new lens to look through, what does it all mean for us? What's the big takeaway from all this? So let's wrap this up. The key thing to understand is this. This probably isn't a true, broad-based bear market. What it really is a powerful rotation of capital away from tech. Now, that could mean the tech sector continues to struggle for another week or two. But the real story, the one that's hiding in plain sight, is the underlying strength in the rest of the market.
And that right there leaves us with the million-dollar question. For years, big tech has been the undisputed king of the market. But if it's now taking a back seat, what comes next? What sectors are going to step up to lead the way? That's the new puzzle for every investor to solve. Thanks for digging into this with me.